Rock and roll. Let's see. Close enough. All right.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services designed to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified day. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. Now, let's see where we are. Okay, one trade right out of the gate that I'm in is the futures on the Russell 2000, which is TF. And at the moment, I have 10 short contracts. And if you go in now, you got a better position than I do. I started shorting about 1375. It popped up. I added a couple more, and I added a couple more. So now my average is just under 1380, and I've got 10. But these contracts got whittled down. They're only $50 contracts now. They used to be $100 contracts. So fortunately, I'm only down $2,500 with a 5-point miss. So I'm hoping that the Fed disappoints and we fly right back down to where we were yesterday, which would be a very nice game. So we'll see what happens. I cashed out. We were long on coffee last week. Today it made 84.75. So we got out of that. I also got out of the silvers. We're just flat on silver now. Because again, it went up to 1350. It had a nice run, and I didn't want to, I don't want to fool around with it, so we'll see what happens. At the moment, I want to concentrate on my Russell trade and hope it comes out well. But so you're getting a better entry than me at 1384, at 1383.50 now. It's falling back pretty good, and we'll see what happens. I mean, we expected some kind of run up into the Fed, but the Russell was up 1.5% at 1385, and if you look at the dollar is down half a point. So yeah, I understand why the Dow is up 0.3, the S&P is up half a point, the Nasdaq's up half a point, but the Russell was up 1.5 points. That makes 1.5%. That makes no sense. Okay, there's no reason it should be flying up 3 times more than the other indexes on the same dollar move. We know it's a crazy index, okay, but it also goes crazy down, so it's more fun to play for me. I enjoy it. Oil is back at 53, almost 53.50, so we'll keep an eye on that. Gasoline is coming back to 165. Natural gas is way down here at 325, where we want it to go long. It's very tempting. All right, so there was a couple of news items about LNG today. Let me see where they were. Was it here? Probably not. Whoops. What is this doing? Oh, yeah. Well, Chevron has a massive LNG project. Now, anytime you see LNG in America, it's for export, okay? But this isn't America. This is in Australia, and they're going to be putting that back online. Now, that might be why our LNG is down, though, because they've got a massive project in Australia. They're going to export natural gas. That's in competition with the U.S. companies that are doing natural gas. And here's Encana, another natural gas play. although not very big on LNG, but they're producing also. So natural gas is going to be in pretty high production. Yesterday, let's see, from Tuesday, there was something specifically about the company LNG, Cheniere Energy. Now this is where we're exporting from America, and I hate this. 1.6 million decatherms a day. I don't know what a decatherm is. Okay, I don't even know how to. How many cubic feet of natural gas? Oh, there's a therm in a decatherm. How many? Yes, that's what I meant. Decatherm. What, I spell it wrong? Yeah, I spelled it wrong. Okay. Here, we're going to all learn something now. Yes, I meant that. BTU. 100 feet. M equals 1,000. What are B? Oh, God. Okay. Oh, here you go. Kyle, thank you. Okay, cubic feet of natural gas. How useful. Okay. So you don't have to read the news and think that it's over your head. You can read the news and say, hey, we can find that. So 1.6 million decatherms a day. And that comes out to, are you going to calculate it this way for me? Wait, I need this to go that way. 166, what? Okay. Wait, let's make sure we have 160, so one more zero. Okay. So that comes out to million, there you go. Billion, 1.6 billion. Oh, is that all? That's easy to translate. So it's 10 times. So apparently 1 cubic foot of natural gas is a therm. So we learned that now. Wait, oh, here you go. Roughly energy, 1 decatherm is 1,000 feet of natural gas, equivalent to a million BTU. That's even more confusing. BTU, blah, blah, blah. Okay, anyway. So 1.6 billion. Now that's the important thing. BCF is what we care about, because that's when you look at natural gas, we have 4 trillion feet of natural gas. So 4,000 billion feet of natural gas is in storage. Okay. Now they are exporting 1.6 billion per day. So let's see if we do 1.66 times 365. That's 600. Okay, there you go. So that's 15% of the natural gas that we have in storage. Now we have something to work with. Where was that news? Here it is. So the Sabine Pass liquefied gas export terminal set a record of now, what is that record? Where'd we go? We decided that was, that's calculated. We decided that was 600 billion cubic feet per year of natural gas. That's how much there. So if we translate that into something we can deal with, it's 600 billion cubic feet is being exported annually from this thing. Deliveries from Cheniere Trail Natural Gas in America have increased since the terminal closed and restarted 3 months ago. According to report, Louisiana started shipping LNG less than a year ago, boosting the supply of exports, raising hopes future export will lift prices and increase, blah, blah, blah. Okay, fine. All right, so now we know. So this news is what I was talking about. This news is telling us that 15% of the total natural gas that's in storage is going to be exported from this terminal. They're opening up more terminals, though, so by the end of the year, it'll be a pretty substantial number. 15% is not insubstantial. If we're exporting 20% of our natural gas, the storage amount of our natural gas, and in a big building week, maybe we build up 200 billion feet. That's a huge addition. Right now we're in a drawdown phase, so we're drawing down 100 and something, 200 billion cubic feet per week, but then it flips the other way in the summer. But as it flips the other way, the LNG exports pick up, and that should bring down our inventories pretty substantially over time. And the longer we wait, the more this effect accumulates. But there's the crosswind that we just looked at of Chevron is out there exporting their own stuff. So that's, so the question is how much extra natural gas output will the world be able to absorb? So I do like natural gas, but it's hard to say where it's going to find a bottom because of all this cross chatter. Okay? 32.25 I thought might hold. It's not holding so far. 32.20 is the next logical place. But if we go below there, as I did say, it's also $3. I would love to be able to go really long at $3 again. Anywhere around $3, I'm going to have huge conviction. You can't afford to have conviction here. This is a very, very expensive drop if you hit it. But long term, the story's there for a build in natural gas. Hey, how come nobody's talking? Uh-oh. Can you guys hear me? Hello? Come on, somebody new say something. John said, oh yeah, okay, thanks. Was that interesting? Nobody had a question? All right. Anyway, so that's my most important topics for the day, I think. And we'll see if this guy comes back. Now, if he comes back down to 1380, I'm going to be able to lighten up and get back to 5, which is what I wanted to be in the first place, was 5 contracts. So always remember that when you're scaling in, when you're adding a position to average your position into a better position, don't forget to get out when you get even. So a lot of people do that. They get a bigger and bigger position, and then it goes back to where it was, and then they just sit there like idiots and don't take the money off the table. That's not the point of averaging yourself into a position. The point is to get a better average, but then get back to the amount that you're comfortable with, not to just keep the bigger amount because it's going your way. It's, greed kicks in. When it starts going down, you're like, oh, well, I got 10, I want to keep 10 and watch it go all the way down here. But maybe it won't. Maybe it'll pop back up again. And you'll have to go through the process again. So you don't just jump in and do that. All right, oil's doing that. The dollar's doing that. The Nikkei is way the hell up there. But we expect the dollar to bounce back up, so we're certainly not going to short the Nikkei, tempting though it may be. Silver is over 1650. Gold is 1165. Natural gas. No, nothing very exciting here except for my Russell shorts I like. But other than that, nothing too important going on. All right, and don't forget we're waiting for the Fed at 2 o'clock. What level would I get back into silver? Well, we have Silver Wheaton, so that's a long-term play. So I feel I'm sort of like not enthusiastic about jumping in and out of silver futures when we have Silver Wheaton as a long-term play, because it's the same thing. All you're doing is making the same bet twice. But I guess here, let's look at this chart. I don't like to pick things. It's like if it shows me. So 1650, see, here's the 1650 line. I'm not sure how it's going to look over here. No, you can't really tell here. All right, so you got to look at days. So 1650, see over here, it was kind of support over there. Then it went down, and it had a big fail over here, and now it's pulling back to 1650. So if we start consolidating at 1650 and it looks bullish, I'd be kind of inclined to get back in long. I got out at 1650, so now I wouldn't mind getting back in at 1650, but I'm worried it's going to get rejected and come back down to 16 again. And it was a nice gain, so I don't want to blow it. So if it came back to 16, I'd love it. I'd love to get back in. If it holds 1650 for a couple of days, I might be inclined to give it a poke and see if we can get to 17. And then over 17, I'd be very happy to go long if it, with a tight stop below that line. But again, I'm not that enthusiastic because we perfectly picked up Silver Wheaton right here at pretty much the low. So that's the big play. And you know, this is just fun stuff. But you know, I mean, this was big money. We just picked this up from 16.50. It's a 50-cent run. It's huge. So I'm not, you know, I'm not dying to jump back in at 16.50. It's just if it gives me a stupid low price again, I'll take it. But basically, each 50 is a sort of stopping line that you can kind of watch and see if it's playable. But you got to see some support there, not just one day. So now we can do a close-up. So here, see, 1650 had trouble getting out. Now it's getting over. Now you want to sort of see it tested going this way. And if it's holding and consolidating up here above the 1650 line, then I would say probably it's going to keep going up. It may go rocking straight up now, though. I mean, there's no way to tell. It went straight down for no reason. And that would be what they call filling a gap, right? So when you're doing charts, here's the gap. This is sort of a gap down. And you want to eventually see that gap get filled. Oh, I'm sorry. Here's the gap we're working on now. So there's a thing called filling the gap, and you know, technically they tend to do that. So filling this gap would be getting back to 17. But then there's another gap to fill, and that's going to get you back to really to 19. So we're talking about like a huge amount of upside potential and a limited downside. But a limited downside, 50 cents in silver is a lot of money. So you don't really want to be on the wrong side of that trade. That's why, considering how volatile silver is, even when it is going up in the pattern, considering how volatile it is, I'm happier with the silver Wheaton trade and get the leverage out that way instead of just playing the futures, because these things will kill you. Silver futures are vicious. So unless I have a really good bottom, I'm not too psyched to jump in. Why not sell some NG puts? I don't do options on the futures. You know, it's not. I mean, it's perfectly valid, but I mean, if I'm going to play, I'll just play the UNGs. You know, it's a little too leveragey for me, and it's not something I also I forget about them because I don't play them often enough. So if I play them, I sort of like do it, and then like 6 months later, like Thinkorswim sends me a notice saying, "Hey, you know, you got to sign this or something." It's just not something I pay attention to in the future there. It's like I like to keep my my boxes separate. Are you worried about Canadian Revenue Agency tax issues for SLW? I'm not worried about it. We have options, so it's not really a tax issue for us because we don't own the stock. So a little different, but I mean, if you're Canadian, you should, I don't know what the rules are, frankly. I just know that in my broker account, if I buy a bull call spread that's $5 and it finishes up $5 in the money, I'm going to cash it out and get $5, and Canada has nothing to do with it. All right, but if you're in Canada, I'd be very concerned about how they treat those things. CL has retraced 50% of yesterday's move down. Are you wanting to get back to 55? Would you take a shot here? No, we were just talking about that in chat. You know, again, you know, this is a problem because a lot of people just we didn't play oil for a long time. I don't believe we played it really all the way up to 55. It's not like we kept shorting it or anything like that. We just let it run. And then finally, when it hit 55 yesterday, I said, okay, I'm putting my foot down and calling a short at 55. Because it was a good spot to make a short. We expected at least a pullback. And now let's look at the bigger chart on oil. I don't think we touched oil for like a week or so. Hours. Okay. So in other words, it did this run, and we sort of lost interest in playing it because it was being, you know, doing what it was doing. I think we might have caught maybe here at 53.50 we did something, but you know, not any serious playing. But then when it finally went up, you know, I just wanted to see where it would end up. So you just let it run, let it run, let it run. It finally hit 55. That's getting silly, and we know that's a 10% move off of 50. I'm sorry, I wish these charts were better. Anyway. All right, so here's 45, here's 55, here's 50. So we broke out over 50. We have a 10% move up. Now we're bound to get a retrace. Now, how much is a retrace? Well, really the move is from 45 to 55. There was a little pullback here, and you could say it consolidated. So there's two different lines that we'd be looking at. We'd be looking at the $5 move, and the $5 move has a pullback to what? 20% of $5 is $1, so 54, and so that's a weak retracement, and a strong retracement would be a $2 retrace to 53. So that's what we have at the moment, a strong pullback off of that run. Now, obviously, if this is 10 though, then a weak retracement of a $10 run is $2. So the same 53 line is a retracement off the 50 to 55 run, and it's a retracement, if it's a strong retrace off the short-term run, which isn't that short, it's a whole month, and it's a weak retrace of the bigger move. So if 53 is holding, that's actually pretty bullish. All right, so now we get back to the hourly chart and we look, and we say, well, it held, but it didn't, it held, but obviously it failed. But in general, it's holding. We throw out a spike. So if it goes below 53, consolidates, it gets right back over 53, which it did pretty harshly, then on the whole, then we're going to say 53 held. Just like here, 53 held. See down here? Okay, 53 held in the end. Just because you want something to hold doesn't mean it can't ever be violated, right? It just means that in general it's going to hold. So we showed some strength here, 53, came back, failed it, but came back, and failed it and came back, and then we held it and went up. So 53 is looking like a good support line here. And of course, we know 5250 is a natural support line. That's not a question. But the move we're concerned about is the move from 50 to 55, and a weak retracement is 54, and it blasted right through that. And a strong retracement is 53. It overshot it, but not by much. And now we're back over it. So the question is, will 53 hold? And if it does, then we would probably look up, but I don't have a reason. I don't feel bullish about oil, so I wouldn't be looking for an up play. But if it fails here and falls back below 51, because that's the bigger move from 45 to 55 is a $10 move, so a weak retrace is $2 to 53, and a strong retrace is $4 to 51. So if we do fail 53 again, and then we go through 5250, I like this for short below the 5250 line, because then we've probably got a good shot to 51. That's a stronger retrace off the bigger move. Then if that fails, forget it. Then they're in big trouble if that fails. If 51 doesn't hold, there's really no support all the way back to 45. So we shall see. But, look, fundamentally, what I care about is what happened fundamentally. Fundamentally, they took a little bit of oil off the market. We have a consistent build. And that's easy to see. So you do the petroleum status report. So we look at the petroleum status report, and we say, well, last year we had oil. Last year we had 455 million barrels of oil, and now we have 486, so 30 million barrels of oil. So basically, and then there's other, the build on this side is 50 million, it went from 68 to 10, so that's like 42, 43. So basically we're building about 1 million barrels a week of product. And it's not the SPR, of course. The SPR is dead flat, so it's got nothing to do with SPR. The total supply of oil products in this country is up 52 million barrels. 52. 50 would be 18. 42 million barrels in 52 weeks. So just shy of 1 million barrels a week too much oil is coming into this country. And though we're exporting 3.2 million barrels of product. We weren't doing that last year. Last year we were only exporting 2.1 million barrels. So we're exporting 1 million barrels a day, and we're still getting $1 million a day more than last year, and we're still getting a build of 1 million barrels a day. So how much oil is coming in? 2 million barrels too much oil is coming into our country. 1.5 to 2 million barrels too much. So OPEC's entire cut of 1.5 million barrels only evens out just the United States' surplus. It's not enough. It's nowhere near enough. So that's the underlying fundamental. It's not going to fix anything. And that's why, so generally I'm looking for ways to go short on oil, not ways to go long. What to make of the coming 1-4 reverse split in SQQQ? Oh, I hate it when I do that. It's fine. I mean, we don't care. So 1 to 4. So for each, for each 4, you're going to get one that's going to be up at whatever. What's it now, like 30? Seems pretty drastic. Oh no, 12. Oh, okay. No, that's right then. Okay. Yeah, so it's going to be like $50. That's fine. It means nothing. It's just a number. I mean, you know what's interesting though? If it's at 50, the moves are going to be very exaggerated because when it gets to 50, the 10% move here is going to go from 1252 to 1375. But a 10% move at 50 goes to 55. So it's going to look a lot nastier as if the market starts selling off. It's interesting timing because I think it would be just about to come back. With SLW, I mean the fine of some 660 million. See, oh, that's nothing. Oh, I'm sorry. I thought you meant like the tax situation with their things. No, that's old news. You'll find that a lot with a lot of things. These things have been in the works for years. So they ran afoul of the taxing authority, and they have to pay this money. But it's really, in the grand scheme of things, it's not that much money. They amortize it over time. It doesn't really count as being a negative to their forward valuation because they did it in the past and it's over. So people shake those kind of things off all the time. So no, I don't see that as being a big. I looked at that before we made the pick, and I decided doing the math on them, it wasn't such a big deal. And if we look at SLW, hopefully they got no numbers. Freaking Yahoo, they're getting worse and worse. Anyway, they're an $8 billion company, and it's their market cap is $8 billion. And it's not going to severely impact them. It's just it'll end up just becoming. It's in the past very quickly, something like that. And boy, is it going to be made up for. If silver shoots up, it's going to be made up for in spades. What are your thoughts on gold? I want to go long. What level is right? Well, I don't like playing gold. I much prefer playing ABX, the gold miner. There's weird stuff going on with gold because you got countries like India are really cracking down trying to get people not to own alternative assets, although they're letting Bitcoin run wild, which I find very interesting. But they're trying to crack down on cash. They want to crack down on everything. They want to make sure everyone has money they can track. I think the demand for physical gold is going to go up because of all the political uncertainty around the world and this crackdown on cash. It's very hard you can't really confiscate people's gold. You can stop people trading gold. You can not allow people to buy more gold. But as far as hoarding it and stuff, it's hard to stop people from doing it. Jewelry and such. You can't come and take people's jewelry away. You can't unplate Donald Trump's bathroom. It's all covered in gold, so he's probably going to keep it that way. I'm sure he's looking at ways to get the White House all golded up too. I think they're allowed to decorate, right? So he comes into power, he'll probably be a lot of gold and decorations. But anyway, so I think there's going to be a physical demand for gold. I think you're going to see a country. Interestingly enough, I believe that a small country will attempt to back their money in gold, which is a very good idea, actually. If you want a strong currency, not too many countries do, by the way, but if you want a strong currency, if you start accumulating gold to back your currency in gold, you will have the world's strongest currency. It will be the only one that's actually redeemable for gold. So that would be very, very interesting. And I think that it would be a power move for a small emerging market country to do that and really strengthen their currency and create a demand for their currency. It's a first mover advantage for something like that. Nobody's done it in so long, though, that nobody's even thinking about it. So that's why I think somebody could pull it off. It's like an outside move at this point. That nobody. It's like using an old trick play from high school in a college football game or something like that. It's just like nobody would think about it, but when you do it, they're like, "Oh, damn! I should have thought of that." So gold. Oh my God, Mike Pence is still talking. How long can this go on? So I think gold is a good buy. I think it's a good price down here. It can go lower though. It's just until we get through Trump's first 100 days, it's going to be hard to say what's going to happen. Because look at what happened since Trump got elected. So if everything people thought was going to happen on a 200-point drop actually goes into play, then gold can get back down to like 1050, where I become enthusiastic about buying gold at 1050. 1150 I'm kind of wishy-washy. But that makes ADX, though, the miner, a really great play. Because ADX, they're the biggest gold miner in the world. They own 100 million ounces of gold. It's in the ground, but it's theirs. So when you look at ADX, they're down here. I wish they'd gone lower, frankly, but they're probably never going to go that low again because they've really brought their production costs down drastically. But they've got 100 million ounces in the ground, so your leverage owning these guys is astounding. And if gold goes up a little bit in price, they skyrocket in value. So that's the way I prefer to play these using ABX. At 1050, I get really excited about gold, but down here, also, by the way, the options on ABX are astounding. Let's take a look. So you can go long on ABX. You can sell the $15 puts in 2019 for $3. Okay, they're at $16.30, so you're netting $12. That's a really good price. You can take some of that money and you can construct a bullish spread. You can go to 2018 or 2019. Now, let's say we start at 15 because they're at 16. So you say you do the I wouldn't pay this. See, this $15 is $5. Here, the 15s are only $3.70. So I'd rather pay $3.70 than $5 because I think a year is plenty of time to give gold to shoot up. So you can buy the 15s for $3.70. You can sell the 25s. Wow, that's aggressive. You can sell the 22s for $1.40. So that's $1.30 net, right? So you're collecting $3 here on the 15 puts. You buy these guys for $1.30. You can even buy two of them, 2 times as many, for $2.60, and that's a 15-22. It's a $7 spread. So you would have 2 $7 spreads, which is $14 of upside for every one of these that you sell of the puts, and it's only $2.80, so you still have a little bit of money left over. So you still have a credit at $15, and you have these spreads, and so anything above 15 is a profit for you, and you're already at 16.36. So you make 2 times 136, which is $2.72 per contract at 16.36. This thing goes up to $22 by the end of the year, and you're looking at getting back $14 for each one short put you sell. So if you do 10 here, you would get back $14,000 if you short 10 contracts here. So I like that trade. It's nice, and it's also pretty efficient. If you sell these $15 puts, in ABX. So the worst thing that happens to you is you own ABX, you own the gold miner, and they're 100 million ounces of gold at $15 a share. That's your worst case scenario. Sell. Yeah, look at that. See, the margin is so small. $1,500 for selling the 15 puts. So it's an incredibly margin-efficient trade. Because that $1,500 and no other cash out of your pocket means that you will get a $14,000 upside on ABX at 22. So that's the way I would play gold, through GLD. You are not going to get back. You won't get that kind of premium selling puts and calls for GLD. That's all there is to it. ABX is much more volatile, but again, since it has 100 million ounces of gold, I like it a lot. That's what they call proven reserves. Please explain how you set up a new position in Butterfly. Just pick a sample stock and show us a new trade. Well, it's not like that, though. You don't just pick one. We have a trade on GI on Guild. Yeah, on Gilead. We love Gilead, so we always have a trade on that. All right, well, I don't want to say Gilead because it doesn't belong to Butterfly. What was the bull call on ABX? The 15-22 bull call spread for 2018, selling the 2019 $15 puts. And it was better than even. You ended up with a net credit on the spread, and you make up to $14 per short put that you sell. Where were we? Butterfly. Okay, first of all, for Butterfly, you have to find a stock that is volatile in a channel, but not really volatile long term. Now, ABX, no, because going from 5 to 23, that excludes it right away. But if you take Walmart, for example, this looks drastic, but it's not compared to ABX, because if you say 65 is your midpoint, right, it only went $10 down from 65. That's only 15% down. And it only went up to 75, so it went $10 up. So in this channel around 65, you're only getting like a 15% variation of highs to lows. So although Walmart is volatile, which means you're going to get good options pricing, it's not so volatile that you're likely to get blown out. Also, logically, Walmart's like a $500 billion company, or 350, or whatever the hell they are. But they're gigantic. So again, when something's that big, they're not going to go bankrupt on you, and they're not going to get bought. Those are the biggest dangers you have in these portfolios, is the company goes bankrupt or the company gets bought, because then it kills you and you have no recourse. So we're right about at the midpoint. So am I worried about Walmart going lower or higher? Let's say I'm neutral to it. So then I go to the Butterfly and I say, well, what do I need for protection? So I say, I'm not going to worry about a 10% move. Okay, that's 10% moves are going to happen up and down, no big deal. I'm only worried about getting blown out on something bigger than 10%. So at 70, let's say I buy the 6250 puts, which are 530, and now I'm going to go up 10%, so I'm going to buy the 7750 calls for 340. So those are my protections. So 6250, I'm buying the puts, and 7250, I'm buying, not 7250, sorry, 7750, I'm buying the calls, and these are 350, and these are, let's say, 550, so it's going to be $9. So I'm going to spend $9 on puts and calls for 2019, and so I'm covered. If anything if it goes crazy and goes too far below or above, I'm covered. So there's a limit to how much I can lose. Now I want to go see what the price of the puts and calls I can sell are. Well, it is January, so if I sell the January calls and raise the money, it's 70. That sucks. I get 133 plus 70 is $2. That's not much fun. What if I go out to April? Or March, in this case. There is no April, so let's say March. If I sell the March 70 puts and calls, now we're talking. Now I get 280 plus 190 is 470 something. So now I'm getting 470. Don't forget, I spent $9 to buy the puts and calls in 2019. Now I'm getting back 470 for selling these puts and calls. So, and I sold 1 quarter, not even a quarter, but less than a quarter. But I sold 1 quarter out of the 8 possible quarters I can sell over the course of 2 years. So if I'm collecting in 1 quarter out of 8, I'm collecting half the money I laid out to buy the position, I'm going to be in pretty good shape, right? So now the question is, what now? How do I become a winner? Well, the puts and calls are going to pretty much balance each other out. They'll decay over time. I'm going to lose about $1 a quarter because I paid $9. I have 8 quarters, so I'm going to lose $1 a quarter in time value. But as far as the value of the position, it's not really going to change very much because if it goes up, then the calls win, and if it goes down, then the puts win. So that's not going to change too much on me. It's really the time that eats it away. But I know that. I plan that. That's how long I have to trade. So what I really care about is hitting my target. So if I hit 70, then both of these expire worthless and I collect 470. If it's at 65, I only collected 470 and I have to give $5 back. So I'm hoping that Walmart doesn't go above 75 or below 65. So that's now the next part of the thing is, okay, it's like, yes, I'm collecting 470 back on my 9, but how comfortable am I that Walmart's going to hit that target? So now I got to go back and I got to say, what do I think? Okay, what's going to happen between now and March? I know they got earnings coming up. I don't think the earnings are going to be special. I don't think they're going to get a big move off of earnings. But what happened last earnings? Last earnings, they went from $72.50 to $60. They made a $5 move last earnings. In July, they didn't seem to move at all. Earnings didn't have much effect on them at all. In May, they had a huge move. Like, that would have blown me out, right? So $62.50, $67. Now, I think we have Walmart in the butterfly portfolio because, but we entered at a better time when we felt more comfortable that they weren't going to move. What's going on? Is this moving? Oh, this is the butterfly portfolio. That was fast. Just went faster than I thought. All right. So, in fact, we're currently bullish on Walmart. We sold we have the 2018 January spread that's almost in the money, and we sold the puts. So we haven't even sold any short positions on Walmart because I didn't feel comfortable selling short positions recently. So we were not comfortable selling puts and calls or anything on this. We just left it as it is, and we're kind of running the clock out at the moment to see where it ends up after the first quarter. Then we'll decide what we want to sell. All right? But as a new position on the butterfly, it's not a great position. So I'm bullish on Walmart. In the butterfly portfolio, we have a bullish position on Walmart. We did not, when the last calls expired in December, when we got this nice sell-off, we did not elect to add more puts and calls. So we're just basically playing bullish with the spread that we have. All right, so so the bottom line is obviously now, there's no simple answer. There's no like always do this or always do that. You have to really think about the position you're in, the risk you're taking, what your tolerance levels are, how sure you are it's going to hit your targets. Okay, you can't just pick any old thing and shove it in a butterfly portfolio. It doesn't work that way. Okay, the hardest part, which is why we only have like 10 positions in the butterfly portfolio, the hardest part is finding an appropriate trade at an appropriate time. So you have to find a stock that's appropriate at a time when you don't think the short-term volatility is going to blow you out. Because nothing sucks more in a butterfly portfolio than putting on a position and then getting blown out in your first quarter. Because if you get blown out in your first quarter, now you're going to spend a quarter or 2 quarters or 3 quarters just to get your money back. And then it's a waste. That means you've wasted that entire position. So we're very, very slow to add new positions to the butterfly portfolio, and we give them plenty of time to mature. Now, the nice thing about the butterfly portfolio is it makes so much money that you don't have to rush into things. You just build it up over time, let it go, and once you've got 2 or 3 you're comfortable with, you add another one. Once that one's comfortable, now, once they're all functioning and making you money, then you can add another one and take on a bit more risk. Do we have a trade on Guild? Okay, so we're going to talk about, I always like Guild, so there's always a trade. We have trades. It's in the, it's not in the butterfly portfolio because it's too volatile, but it is certainly in the long-term portfolio. Oh, wow, 141%. Damn, that thing is moving. All right, Guild. So what do we have? We have, ooh, messy. All right. We have the 70, 82.50 bull call spread. We sold the 90 calls. So we sold the 2018 90 calls. We have the 2019 bull call spread. And we also sold these puts. So we sold 10 of those and 10 of those and this and that. And the net on the thing is 26 minus 16 minus 10. So there's a net credit on this whole spread, and it can pay up to $12.50 times 20 is $25,000. So this spread can return $25,000 off a net credit. So that was a good trade. As a new trade, so we're just basically gung ho bullish on Gilead. So we're not aiming to. We did sell 90 calls. I didn't think 90 was going to get hit that easily. What's going on here? Very slow. That's weird. Shoot. What's going on? Oh, there it is. All right. So they're at 76. Frankly, I mean, you can sell these. Look at this. You can sell these. Wow, really? 530? Wow. Okay. See, you can sell the $60 puts in 2019 for 530. To me, that's like free money. Of course, I want to buy. There's 76 now. Of course, I want to buy them for 60. Give me another $16 off 76. That's 20-something%. Yes, I would buy them for that price. Therefore, this is free money. So you take your 530, you sell these puts. So you're saying, I promise to buy Gilead for $60, and you do 5, 10, whatever number of Gilead shares you really want to buy for net 60. Now you've got free money. So you have 530, and you take the, let's say you do the 65 calls, which are, all these numbers are whacked. That's 17, that's 19. So call this 18 in the middle. So you take 65 to 18, you sell the 80s, $15 higher, you sell the 80s for 10, so you're going to net 8 over here. So it's 8 minus 530 is $3. So that puts you into the 60, 75 the 65-80 bull call spreads with the short 60 puts, and the net on that trade is $3. And you're you're $11 in the money, and you're only paying $3 for the spread. So all it has to do is hold this price, and you're going to make a lot of money. You'll make double, triple, easily, and you'll get up to $15 back on your $3 on the cash outlay. So yeah, I love Gilead. Anytime anyone asks me about Gilead, I'm like, these prices are fantastic. Especially in this low VIX environment, to be able to get that kind of money for puts and such for selling is amazing. How are you on time? Almost bedtime. Okay, great. We have a 8100 blah 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 wind butterfly. Time to roll the short January bluff. Okay, yeah, that is the wind kind of fell out of our zone a little bit, but I mean we bought it because it usually stays in its zone, so I don't know if we want to get out right now. No, they're doing what they know. They're doing exactly what they always do, and that's why they were a good butterfly candidate. This is not the butterfly portfolio. Butterfly. Okay, so win. what do we have? Well, breaking it down, we have we have the 2019. Well, this was a traditional butterfly, so we went a little bit light on the puts and calls because it's our first attempt at it. The traditional butterfly is we bought the 120 calls, we bought the $80 puts on Wynn for 2019. That gives us 8 quarters to sell. We sold January, actually gave us more than 8 quarters to sell. But in January, we sold the January 100 puts and calls. We collected, what you got to keep in mind, we collected $11.90. So as long as it's within $11.90 of 100, we're going to make money. And where is Wynn now? It's at 90, so we're right about in the right place. Okay, so it's at 90. We need to be within $11.90 of 100. The closer it is, the more we make. All right? Now, we bought the longs for $14 and $11. We bought the longs for $20. It's an expensive spread. We bought the longs for $25. So we don't want to only make $2 because we only have 8 sales ahead of us, right? So we would lose money. We're hoping we collect 11. So the idea though of looking at Wynn is over time it's extremely volatile. That's why you get such amazingly high prices for the options you sell. It's very, very volatile, but it always tends to come back to its channel. So looking at it, it's not doing anything different than it does all the time. It's going, look, down, up, here's 100, 85, 105, 85, 103, 87, 108, 82, 104, 85. So why would I panic now? It's doing exactly what we expected it to do. It's going up and down crazy, and once in a while we're going to make these hits. We only have to make a couple of hits right at 100, and we're going to be in great shape. So yeah, we're going to give it 3 weeks, and hopefully it comes back up around 95, and we only have to give back $95. We only have to give back $5, and we won't give it back. We're going to roll the losing position, but we would only give back $5. That's another thing, by the way, is over time we widen the spread. This is only our first sale. So it was our first sale. We didn't have any particular opinion about which way it would go, so we sold the 100 puts and calls. We just sold the most premium we could because we didn't really have an opinion on which way it would go. But no, we don't change the butterfly portfolio unless it's drastically off track, which this is not. You don't change it. You let the time do its work and eat up the premiums. And these premiums now, they're not even losing money. It's 1065 plus 23. So it's basically they're fine. There's nothing wrong with this position at all. Okay. Thoughts on Ford prior to special dividend? Good time to buy, and if so, buy. Then what? Ford. Well, you can when you have these special dividends, if you don't know how the options are going to get treated, and I don't, frankly, you may end up paying the dividend out of the option. Like your option may carry an obligation to pay the special dividend or something. So that you really kind of got to check with a broker or somebody if you're thinking of playing it. As far as in general, though, I like Ford. And if you want to capture the dividend, then you buy the stock, obviously. So, the stock is $13.20. And I would just, again, I'm not sure what the special dividend deal is, but I would just look forward. I would just basically say, okay, $13.20 is a good price, but I can buy it for $13.20. I can promise to buy more for $10 and collect $1.15 or $1.10 for the puts. So that lowers my basis from $13.20 to $12. Then I can sell the $12 puts and the $12 calls for $2.30. All right, so I'm net 12. I'm going to get called away for net 14.30. So I'm going to make $2.30, which is 20% in 2019, plus the dividends, plus your special dividend. And again, assuming that you don't take a hit on this short call for the dividend paid. But that's for me, that's the conservative way to play. If you want to capture the dividend, that's the way to go. Nothing fancy. You sell the $10 puts and the $12 calls. You knock $3.50 off the price. So you're netting in for like $10. You're going to get called away for 12. That's 20% profit there. If you get called away, of course. And you've got plenty of downside protection. And your worst case scenarios end up owing 2 times as much for an average of $11. As long as they keep paying those dividends, that's going to all go in your pocket. All right. Just got to find the Fed minutes, so let me get on that. I don't think Yellen is scheduled to speak today. It's just going to be released in a minute, but you never know. From a shorting perspective, I'm a little bit concerned because the markets are obviously predisposed to interpret these minutes bullishly. But, I mean, there was no indication in the statement that this was heavily bullish. So that's what I'm basing this on. Is I'm willing to go short because I don't think that there's anything in the last statement that really indicated that they should be that they were going to be extra easy or easier for a longer time or anything like that. But it all comes down to how it's interpreted and how it's kicked around. And we're not going to read all the minutes. So we'll just see what happens, basically. So natural gas is holding 325. These guys are still right where we started at 1384, so we'll see what happens there. Oil is 53 and a quarter, but not getting over that line. Gasoline not making 165. The dollar still down at 102.50, which is weak, even weaker than it was when we started. Now, that's going to be the worst dollar on the Fed because if the Fed seems like they're going to be tighter, then the dollar will go up, and if the Fed seems like they're going to be looser, the dollar will go down. So we'll see what happens. I've got about 4 more minutes until that goes. Any thoughts on the Nikkei? Well, the Nikkei likes a strong dollar, and Japan just had some very good manufacturing numbers today. So it's up. I mean, a lot of it is short covering because everybody's down on them anyway. We liked the short yesterday because we expected just a pullback. You have a big run, you expect a pullback, okay? But once you have it and you get it, you don't keep going back to the same well, okay? We got the move we wanted. We had a nice little pullback on the Nikkei, but now it's back up, which shows actually strength, if anything. So, here's where we opened, and then we had a nice pullback here, but then it went flying back up. So we didn't even want to play with it this morning. But we are back where we were on December 20th. So keep that in mind, okay? It really didn't sustain this for very long. Now we're consolidating, though. It's doing better, and the dollar's nice and strong, so I wouldn't, I wouldn't mess around with it right now. And if you look here, see 20,000 was where it topped out last year in December. So if the Dow's going to hit 20,000, these guys are damn sure going to hit 20,000, and they're behind. Thoughts on the dollar? We're the only central bank that's tightening. So, of course, the dollar is going to be strong. The entire European... Look, there's really only 2 currencies in the world. There are dollars and there are euros. Well, no, sorry, dollars, euros, and yen. And dollars are like 60% of all the money in the world. Euros are 25% of all the money in the world. Yen are 10% of all the money in the world. maybe 5%, sorry, more like 5% of all the money in the world. Everyone else is not even at 2.5%. So you have us and Europe at 85, the yen makes 90, and the biggest other person is probably the British pound for 2.5% or 2% or something like that. And then behind them, you got a couple other bullshit currencies. But all of India, all their currency, 1% of the money in the world. All of China, all their currency, 1% of the money in the world. It's all about the dollar. You know, other currencies exist, but they're in very, very small amounts comparatively. And that's why when they talk about the yuan becoming the biggest currency in the world, it's bullshit. The time and effort it takes to get there is staggering. You know, and they talk about oil. No, they talk about the Arabs saying we're not going to trade oil in dollars anymore. Good luck getting enough euros to trade oil in. You can't do it. There aren't enough euros. So what will happen if they start trading oil in euros, the value of euros would skyrocket relative to the price of oil, and they'd end up getting much less than they're getting now. You can't force a currency in and out of status. It takes decades of trading and decades of transactions that establish the position and naturally creates money in the bank. Not, you know, the Fed can't just write the money. That doesn't work, not for real reserve currencies. It has to actually accumulate over time in real transactions. So therefore the dollar, since we're the biggest currency, we're the only one with a reserve bank that's tightening at the moment. So the dollar is going to remain relatively strong to everyone else. Not only that, though, but we have a rising labor market. Thing came out. We have a rising labor market that also strengthens the dollar because there's more demand for dollars. So, meanwhile, the dollar is staying down on the release of the Fed minutes. Let me see what they say. So the Fed says what I just said. The Fed says the downside risks to the economy are a stronger dollar. So that means, but that's good though. That means they don't want the dollar to be too strong. So the dollar is now coming down. Now you can short the Nikkei at 19,640 because the Fed just said they don't want the dollar to be too strong, and they're also worried about weakness abroad in other currencies, which is just what I said on TV yesterday. So now the dollar is failing 102.50, getting weaker. There's nothing bullish about the statement the Fed just made, but nothing too bearish either. It's kind of a neutral statement. But if you wanted to play something, you can go with a Nikkei short now. So we go here, and we'll say NKD, and just go dip. 19,635, and let's see if we can stop around 2. So over 650, I think we'd stop out of this thing. And now if we're in the Nikkei, we want to watch the dollar, which is getting weaker. So that's our premise, is the dollar is going to be weaker. And if the dollar starts drifting lower, the Nikkei typically does not like that and will trade lower as well. All right, let's take a look at the actual minutes now and read it and figure out what it says. Whoa. Change the format. Developments. High probability increase of the Fed's target rate at this meeting and pass it, blah, blah, blah. Okay, that doesn't matter. Okay, staff review of the economic situation. So don't forget, this is as of mid-December. So GDP was at a moderate pace over the second half of the year. Labor market now you got to keep in mind what actually happened in this time. The Atlanta Fed, who gives that GDP Now forecast, they're up around 2.9% right now as their expectation of fourth quarter GDP. Consumer price inflation increased further above the pace is below the committee's, so there's no change in policy there based on that. Taken together, the range of indicators showed that labor market conditions are tightened. We know that. Non-farm payroll increased solid pace. Unemployment has declined. The share of the workers. So what does the Fed care about most? They care about interest. They care about inflation, and they care about jobs. That's what they care about. The jobs are well in hand, and they'd like to see inflation a little bit higher, but not too much, and they're very scared of overshooting the mark with inflation. Little change. October, the 4-week moving average. Labor productivity was flat. Measures labor compensation rise at a moderate pace. They also don't like wage inflation, so they're going to move sooner rather than later to make sure we don't have wage inflation. Compensation per hour in the business sector rose 3%. If unemployment rates, blah, blah, blah. Total industrial production was flat in October. Now we know industrial production picked up since then. So one of the negatives is off the table. Real personal expenditures appear to be rising at moderate pace. Consumer expenditures modestly. Unit sales of motor vehicles were higher. All this is still true. Recent real disposable income net worth was consistent with the PCE for the fourth quarter, still true. Recent information on housing suggested residential investment was picking up in the fourth quarter. Building permit issuance for single-family homes indicator underlying trend in construction also agreed. And we had a little bit of weakness since then, but that's because they raised the rates. Frankly, they raised the rates. They caused the slowdown in construction. Real private expenditures for business equipment and intellectual property seem to be soft. Government purchases looking to rise moderately. Now, there's another thing. They know that the Trump administration is coming and they say they're going to boost infrastructure spending. That's going to change that. So they're already looking ahead to say that's going to change. Payroll, state and local government expanded. U.S. international trade widened. Consumer prices indexed 1.5% over 12 months. That's inflation. That's their target is 2%. They're right about here. Course PCE, which includes, and plus energy is now up, so they're actually probably over their 2% goal. Oil prices have kicked up considerably. Foreign real GDP growth picked up, blah, blah. And we've seen signs of that. We see better GDPs, better manufacturing numbers, all kinds of stuff. Blah, 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 blah. Okay, so there's nothing here to indicate that they would not continue to tighten. That's the bottom line. Okay, but they're also not in a hurry to tighten, so you're probably looking at not even March. Well, what's their meeting schedule? Let's see. 2015, 2016, next year. So not March, certainly not January, because they just hiked. So not March, now you're looking at May or June for the next rate hike. Trump comes in here. They're not going to greet him with a Fed rate hike. March, I think if I were the Fed, I would still want more information from to see what the economy is doing in Trump's first 100 days. So May, if the economy is doing well, in May we could expect a rate hike. And that gives them time to do another one in June or July, and they'd have two under their belly, and then they can just do one more by the end of the year, and nobody's going to be too harmed by an 0.75 rise in rates. All right, so that's where we are. There's nothing here that would indicate the dollar should be stronger. So that's back to our premise. That's what we thought. That was our knee-jerk reaction, and we think that's going to hold up. So here we are, 102.50. Here's Nikkei drifting in here. So nothing's working so far. It's just sort of everything's drifting along. All right? But when you have a report like this, and it's not extremely obvious what's going on, you have to imagine that all the hedge funds are having meetings right now, and they're having discussions just like the one we were having, and saying, well, what does this mean? How do we want to position ourselves going into the end of the year, into the beginning of the year? What do we want to say into earnings, so on and so forth? And so from this report, we generally get the idea the Fed is on pace for moderate tightening next year, but still in that play it by ear kind of mode. But that's nothing to tighten. That's nothing really that makes the dollar deserve to be much higher than it is right now. All right, and we'll see how the Nikkei feels about that. So far, it's not going our way, but got to give it a few minutes and see what actually happens. Yeah, you can apply the 5% rule any time to anything, whatever time frame you're working in. The only restriction is you need to see a consolidation. So in other words, you've got a good consolidation here. You have a kind of consolidation here, and since you have one here, you could use this line for an intraday trade. So you're 22.50. You go up to 22.60. And you shot over. So you say, okay, that's 10 points, and an overshoot would be another 20% of that, would be two more points. So 22.62 is where you'd expect to get. But obviously you're kind of over that line. So now you got to look back here and say, well, maybe I should be looking to run from here. You got 22.40 to 22.60, because it went shooting up to 22.50. Held that. So really it's kind of like a 20-point run, and plus you already have this 20-point drop to get there. So you have a 20-point run. Now it makes a little more sense. In a 20-point run, you'd have a 20% overshoot, would be 4 more points. And you see how it stops right there at 22.64. So you have a 20-point run with an overshoot. You're at 24. So that makes 22.60 a very significant line on the S&P. Now, if that holds, though, you really have to look back further and figure out what's going on. So we go back to the futures. And now we see what's going on. So is 22.60 significant support? Yeah, because you got this whole line here, and you have that nice one where it tested and came back. And up here you had consolidation, and here you had consolidation. So yeah, 22.60 is a significant support line for the S&P. So you want to run your, now you want to look at your calculations from 22.60 and figure out what's going on. So you take 22.60, 2260 times 0.975, that's 2.5% below, is 2203. What? Really? No, that's too far. So 2260 times 0.9875. That's 1.25% below it. 2231. So now we know that this is a 1.25% line, and this is your goal. So the run we should be looking at is this run, from 2230 to 2260. That's a 30-point run. You expect a 3-point overshoot. I'm sorry, 6. A 6-point overshoot, which we got, and now we're pulling back. But that's the run we're looking at now. It's 2230 to 2260. That's your significant run. And from that, you want to do your calculations. But if we're holding 2260, it's bullish. That's the bottom line. You popped over. You're not even pulling back enough to test 2260. That means this thing's not done, which means then you got to pull further back and say, well, what is going on there? Then you say, and I know 1850 is our must-hold line, so you got 1850 times 1.10 is 2035. So here's 2035 down here. This is the run. 2035 to 2260 115 points. Nope, sorry, 215 points. Nope, 225 points, sorry. 225 points. And that means 50 points up or down would be a 20%, either a 20% retrace, 50 points down, or 50 points up through 2,300 would be an overshoot. And on the whole, what that means is the S&P is a very tough, dangerous thing to play over here. That's the gist of that thing. When you get right back down to it, you say, okay, well, this thing could go either way, 50 points. And frankly, looking at these things, looking at that stick here and this stick here, it could do it overnight. It can do it. Look at this. There's 100 points in a day. So, there's no particularly great catalyst here. You don't know what earnings are going to be. It's just not a good time to play it. That's the bottom line. So yeah, I expect 3 raises based on what I just read. But I haven't read everything. But based on what I looked at, it seems like 3 raises make sense. Are you sticking with your 50 stop on Nikkei? If so, it's been hit. Ugh, really? Already? Ah, bastard. So we're in at 40, and it did blow over the stop, but the dollar's not really doing anything yet, so I'm not really looking to bail. Although my Russells aren't doing good, so I probably shouldn't have 2 of them open, but I'm not really looking to bail. If it's staying down here and behaving itself under this line, this red line, I think I'm right. I think I'm right, but it's complicated, so it might take people a while to realize I'm right. But no sound. Really? If no sound, refresh. That's true. Yes. If no sound, refresh. Oh boy. Does anybody have sound? Can anybody hear me? JW says he has sound. Anybody else? Yes. Okay. 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 Good. Thanks. All right. Okay. All these people can hear, not on my end. Okay. All right, yeah. So I'm going to restart the thing just because somebody lost their sound. Not that I think that helps anyway. All right, cool. All right, so what else? We got to all that stuff. Let's take a look quickly at our portfolios and see where we stand. So, ooh, that's weird. So, starting with the options opportunity portfolio. Nice, 141.8. Where were we? Seems like a lot. Just did a review, right? Here it is. Looking back at 2016. It's the long-term portfolio. Yikes. This is a short-term portfolio. Butterfly portfolio. Options opportunity portfolio. Where were we? 137. Yeah, so we were 137. We gained 3% since the weekend review. That's not bad. We haven't touched anything. They're all the same positions. So this thing's doing exactly what, 4%, sorry, 4% up. So this thing's doing exactly what it's supposed to do. You just sit here and collect money. It's not hard. The same positions. They're well balanced, and if they're well balanced and we've sold a lot of premium, which we have done, then that premium over time is going to accrue and drop into our portfolio. So that's good. So what we have it is very, very well balanced portfolio. We have I just did a review. I'm not going to do a whole review, but we have all these different positions. Frontier is finally coming back a little bit. That's nice. We have Apple, we have ABX, we have Cleveland Cliffs, we have DBA, which was our runner-up for the trade of the year. We have Disney, we have Go. Disney just got upgraded. We have, and were we bullish on them? 90, we own the 90s. Oh yeah, this is bullish because we don't have any offsetting. We have nothing short here. We own the 90s. So we have the 90-105 spread, which is in the money, and we sold the 80 puts. We have GoGo, we have Joe's Coffee, we have Kate, we have Macy's, we have SCO is short on oil. That one's not working so well. Well, actually, it's not working so well, but it's making money, so who cares? SGYP just had a good day. They're moving up. Silver Wheaton is our trade of the year. We have that one. Sonic, I just picked this morning. I just talked about Sonic in the Morning Post. SunPower, Taser, Twitter. I like all these things. UNG. I mean, Twitter, I like it. We got it so cheap. We bought the $10 calls. They were $16.75. You think Twitter's not doing anything? We don't need it to do anything. It just has to stay where it is now. We're going to make a fortune. UNG, Weight Watchers, Oprah is coming through for us on that one, and that's already in the money, 100% of where we are. And even Exxon is coming back to where we want it to be. So everything's working. A good portfolio. Butterfly, we just looked at briefly. All right, they're up 230%, which I think is probably about where they were on the weekend. With Butterfly. Ooh, 238, really? That's interesting. Okay, so something in the Butterfly took a hit. Because we're only at 230 now. We lost 8% on this portfolio. Now, you can't worry about it because it just goes up and down and fluctuates. So, depending on what moved and what changed. But the basic positions are, we have Microsoft, Valero, Walmart, Apple, Costco, Disney, General Mills, Microsoft, Procter & Gamble, Target, Texas Instrument, UNG, that's actually a bullish trade on UNG. It's not even a proper Butterfly. Valero, Walmart, and Wynn. So I'm not sure which one is hurting us so badly. I have to imagine it's Texas Instrument because we're accidentally short on it. I don't see anything else that would really cause such a big problem. Anyway, but the point about the Butterfly, though, is it goes up and down, but it doesn't really matter. Okay, what matters is where you end up at the end of the month, and then we do our adjustment. So 2 weeks from now, we'll worry about the Butterfly portfolio. Then we've got the short-term portfolio. 365 is down a bit. I think it was probably 375 on the weekend. But that's what it's supposed to do because the market went up, and therefore the short-term portfolio loses money. Yeah, 375 it was on the weekend. But the long-term, so that's down $10,000 from the weekend. But the long-term portfolio was 1179, and now it's at huge. 1206. So you see the short-term portfolio lost $2,000, but this one gained almost $30,000. So these are doing exactly what they're supposed to do. The hedges in the short-term portfolio are losing money. Ow. One second. What the heck? Wait, I got something sharp in my foot, in my sock. I don't know what it is. A painful piece of plastic. All right. Anyway, I don't know how that got in my sock. What was I going to say? Oh, yeah. So these are doing exactly what they're going to do. Unlike the options opportunity portfolio, which is self-balancing, the short-term portfolio is split away from long-term portfolios. Two portfolios that balance each other out. So that way we concentrate our long-term don't-touch positions or in the long-term portfolio. We have no need to do anything with them generally. They just sit there and they make money. And they make, fantastic money. The short-term portfolio is much more volatile. That's where we make our adjustments. And now, normally, because this portfolio when it started was $500,000, the short-term portfolio when it started was $100,000. Normally, in a downturn, we transfer cash to the long-term portfolio from the short-term portfolio. But we never had a downturn. The freaking market has gone up and it started in 2013. We've never had a significant downturn, and the short-term portfolio has made money. So now the short-term portfolio has gone from $100,000 to $500,000. This one's gone from $500,000 to $1.2 million. And this one's not supposed to go up like gangbusters, and neither, frankly, is the short-term portfolio. We just happen to have really good timing in our when we took off our hedges. But usually, so in other words, usually when we make that money in the short-term portfolio, we transfer it to the long-term portfolio, but we haven't had any need for money in the long-term portfolio. It's never been damaged in any kind of way that we needed more money. And now we've got almost $1 million in a portfolio that started with $500,000. We've got $900,000 in cash. So, we are really in good shape. I mean, I don't think we could be in much better shape, frankly. So nothing to do there, nothing to touch, and nothing to change. Did you stop out of the short TS? No, I did not. Is NVIDIA in a bubble now? I think it's ahead of itself. I don't know if I call it a bubble. Oh, damn it, look at these Nikkei. And the dollar's going up. Maybe I'm wrong. That's a shame. So it's making a new high. I'm down $500 there. I'm not changing these. I think I think all the indexes are going to pull back. So we'll see. But hopefully the stronger dollar will knock back these indexes, but we'll see what happens now. So I'm kind of stuck in this trade. I don't want to add more because I already have these shorts. So I'm just going to wait and see where things calm down. What are the other things doing? Let's see what everything's doing in one quick. So the Dow plunge. These are like all a big spike up. I don't think I really believe this action. I'm not buying it. Gasoline, natural gas, oil, still 53.25. Here's gold, here's silver. See, gold's not moving, silver's not moving. The dollar is hanging out where it was. Oil isn't going anywhere. I don't think these are legitimate moves. I think that basically I should stick with my shorts. I mean, obviously any spike up in the dollar is going to get the Nikkei excited, and that's what's going on now. But I still think that move has been done. Tuesday night, the dollar went up to 103.80. So that's a whole % higher than this. And all the Nikkei made it to was 19.5. Then it pulled back significantly. So I think if I stick this out, I think we're going to get a pullback. So that's my instinct, is to stick it out. Although it did not go the way I thought, not the trade I wanted it to. I don't, just because the dollar's not doing what I thought it would do doesn't mean I'm wrong. It just means it's not right away. And you can't always get right away. But NVIDIA is like a crazy stock. I mean, that's it just so happens they lucked out. Wasn't anything brilliant that they did. What happened is, because of the game controlling technology they use and the chips they build for all these games to have these efficient little things that do repetitive, that work in devices to do repetitive things very quickly, it's perfect for the Internet of Things. So the stuff they have, people have just been running to them for their chips. But still, it's only until people catch up with them, other chip suppliers will start making these kind of chips. They just happen to already be making them for games. So when everybody realized they've already got the chips that everybody wants, their sales went through the roof. But now, other companies are putting their fabs online, and they'll start making these chips, and the competition will get there, and the margin will be there. It just won't be this runaway hit that everybody's paying for now. I wouldn't short them, but I certainly wouldn't go long on these prices. Well, the dollar, the only index that really likes a strong dollar is the Nikkei, because the Nikkei, well, Japan's entire economy is selling stuff to us. You know, they really like a weak yen. But you assume when the dollar is strong, the yen is weaker. You know, the Nikkei likes a strong euro too. They like a strong euro and a strong dollar. The euro isn't changing much. You know, because they're very export. I guess China also likes a strong dollar. They're very export-based economies. So here's the yen down here, and if you think about the horror, I mean, for the poor Japanese people, look at this. That's 170 on the index in 1996. This currency has lost half its value. It lost half its value here, in fact, in 2007. They've been relentlessly devaluing their currency. When the crisis hit, everybody ran to the yen, and it got stronger. And then Abe came in and said, "Oh no, we're having none of that," and he pushed it back down. They want a weak yen. The goal of their whole economy is to have a weak yen. And here's the dollar, and they can't have a weak yen if the dollar's strong. That's what started going wrong for them here. The dollar got weak and the yen kept going up. Here's the euro. Euro's weak too. It's also terrible. I mean, look at it. 160 to almost 100. Losing about a third of its value. You know, all these currencies are a joke. We went from 130 to 80. That's 50 out of 130. That's more than a third that we lost in buying power, and we're getting it back now. But this is normal for the dollar. It's around here. This is where the dollar should be. It should never have been this low. It should never have been this high. But you can't, you know, just because something should be a certain thing doesn't mean it's not going to fluctuate. So as a rule of thumb, though, it's Japan and China love a strong dollar and a strong euro. But we don't have a strong euro. That ship has sailed. Okay, though, in 10 more years, you'll be lucky if there's a euro at all. That whole thing is a dysfunctional, monetary union. It really doesn't work properly. So yeah, for export-based economies, for export-based economies that export to America and to Europe, I mean, obviously, it matters where they export to. It's all relative. You know, Switzerland almost bankrupted themselves trying to prop up the euro because they export to Europe. That's all they care about. So they were attempting, as their own little tiny central bank, was attempting to constantly buy euros to prop it up. That kept the euro from dropping for quite a while because the Swiss were always running in and buying euros. Around here, see in this area? This is Switzerland constantly buying euros and trying to keep the euro up around 130. When they finally gave up, though, because it was killing them, it was driving them into ridiculous debt because they kept buying these euros for above market prices and nobody wanted them and they were worthless. And so the Swiss got stuck with the bill. So when they stopped, once they took away their peg, boom, the euro basically fell apart and went back. But it only went down to where it would have been if they weren't messing around with it. That's the problem with all these intervention schemes. When you stop, you get a very sharp, very ugly correction. What time does Nikkei close? Same as T? Yeah, I think they close around the same time as the U.S. futures. 19.7? Oh, you're kidding me. I got to pull the plug on that. Damn it. All right, I was wrong. The dollar went up, even though I don't think it should have. And everybody's up. But, you know, they're not making new highs. The Russell's not making a new high. They're at a new high. The Dow's not making a new high. So I'm going to hang my hat on that and stick it out, I think. Because fortunately, it's only 2 contracts on that one. Still $650 lost. I'm not going to add to it. I'm just going to expect that it calms down a little bit. But maybe not. Maybe I'm going to get burned. Look, the dollar's still rising over here. 107.8 almost. There's 102.8. Sorry, 102.8. I think this is wrong. I think the interpretation of the Fed minutes is wrong by these people. But what am I going to do? I can't stop them. They're going to think what they're going to think. What's happening in Deutsche and the Italian banks? I thought they were in big trouble. Well, the Italian banks kind of got a bailout, mostly from them just reclassifying some of their debt, so that they weren't it's basically like we changed the rules so you're no longer in imminent violation. So they kicked the ball down the road. Deutsche is in the same boat. They basically changed a lot of the reserve rules and changed the testing rules for the banks so that they were no longer in violation of their parameters that they were supposed to be within. It's not a long-term fix, but it's a short-term fix, and they're just hoping the economy improves. Now, at the moment, the economy is improving, though. We had some good economic numbers out of Europe. So if all goes well and the companies that they lent money to stop defaulting on them, they could actually right their ship by themselves. And this is why you bail out banks. So you bail out banks because, as a government, you say, well, the banks are being owed money by businesses that are failing. If we stop the bank from failing, we can the banks will let the businesses string along without failing, and the businesses stay open, and the bank stays open, and eventually, hopefully, the cycle comes back. That's the whole point of doing these bailouts for banks. Businesses go. Economics is in cycles. You hope for the best, and you try to help the businesses ride out the cycles. So we had a really nasty downturn. Now, the real danger to the banks in Europe, it's not the cycle, it's the fact that the ECB doesn't want to step in and do something about it. In most countries, it's a knee-jerk thing. The problem Italy had is it was questionable whether Italy would be allowed to bail out their own bank, because technically they're not allowed, because they're in violation of GDP, of debt to GDP numbers. In the Eurozone, there's all these rules every country has to follow. You can't do this, your government can't do this, you can't spend this much more than you earn, you can't run this kind of deficit. So all that comes into play when you're talking about, giving a bank $20 billion. But when you think about it in the grand scheme of things, what's $20 billion? So that's what ended up happening, is they kind of worked it all out because they weren't going to let the entire Eurozone fall apart over $20 billion. Now, Deutsche Bank has much bigger problems than $20 billion. They're around $200 billion. That's kind of serious money. But they've also been given all kinds of extensions and breaks and so on and so forth. And I guess they're trying to, unwind without making the bigger deal of it. But again, what's $200 billion? We bailed out our banks for like $6 trillion in the U.S. We just handed money away. The Fed ran their balance sheet up $3.5 trillion just on their balance sheet, taking assets off the bank's hands. Troubled assets, TARP, the Troubled Asset Relief Program. That's what TARP stands for. Who were they relieving? They didn't relieve the homeowners, they relieved the banks of their troubled assets. And then all that joy trickled down to the average people, right? So we averted the crisis in Europe for now. It's off the table at the moment. But all these things are just kicking the cans down the road. Nothing is actually being fixed. We just keep kicking the can down the road and hoping the economy grows big enough to catch up. But we're getting good indications of that. So you have to imagine that we could actually get through this thing. Okay, the global GDP could expand 3.5%, 4% next year, and that's an extra. Our GDP in the planet is like $80 trillion now. So if it expands 4%, that's $3.5 trillion more dollars. And a lot of that money does flow through the banks. So if the banks are able to get their hands on fees of $3.5 trillion of additional transactions, maybe they pick up a few $100 billion extra dollars in profits. And there you go. Crisis solved, right? So yeah, just because you hear someone's in trouble, it's really a question of what are they going to do about it? Not that they're in trouble. And the problem that Monte De Pesci faced was that the Italian government's hands were tied and they couldn't bail him out. And if you wait for the ECB to do something, you can wait forever. But they all worked it out so that the Italian government was able to save the bank, or at least, get them out of immediate trouble. All right, Sean, why not stop out and play when it crosses below 9.7? Yes, I should do that. But, again, I want to see how it closes. I want to see where we go. Wow, look at that. Wow, the dollar is flying up. So I'm looking very wrong at the moment. I just think this is too much of a move for the Nikkei. I mean, you're from 19.2 to 19.7 is a 500-point move since yesterday. And we have not had a significant pullback from that. So I would just rather be in it for the pullback, frankly. And I could be wrong. I mean, everything's popping right now, and they're looking, they want to go to, they want to hit 20,000 here. So we're so close. All they got to do is pump the futures up tonight. And to do that, all you have to do is have Goldman and J.P. Morgan come out and upgrade a couple of sectors. Or even better, if somebody makes a big M&A announcement, that always works. See, there's always these M&A deals in the pipeline. And what the banks do is when they need to boost some sector in the market, they announce the M&A deal. That's why sometimes you hear M&A, they all come in bunches. And the reason is because they want to push the market up. And when they want to push the market up, they announce these M&As, which they've been working, the banks know what they're in, they know what the pipeline is, they're involved in it, but they decide when they're going to release the information to the general public. And it's a wonderful way to boost a whole bunch of stuff when you upgrade a sector, when you say, oh, this guy's buying this guy for X amount of money, and then you start saying, well, if this restaurant's being bought for 40% over what it is, then maybe the whole restaurant sector is undervalued, or retail, or whatever it is they're doing. So it's all just a game. They manipulate people's perception of what's going on. But anyway, so my call is to stick with the shorts overnight. I want to see what happens, and if I get burned, I get burned. Fortunately, the silver trade was good to me today, and the coffee trade was good to me today. So we'll see. And now we're getting a nice little pullback in silver. So I definitely want to go back in on silver. I want to go back in on coffee, but for now, I'm feeling more comfortable with my shorts, even though they're not working. Still like them. All right, so we're going to shut this thing down, and last questions, and we'll be done. What month your DX trade station is March, and it's about 11 and 12 lower than yours? Interesting. Oh, yeah. No, it says it's defaulting to H7, which is March. Active contract 102.70. And what does it say on my chart? 102.70. So I don't know. Apparently it's the H7 contract. So you might want to check yours, but that's what Thinkorswim says. They have a disagreement about the price. Nah, that's way too far off. But clearly that's what it says. It says it's the H7 contract. All right, guys. So unfortunately, I still like this trade. This is where we came in basically at 1385. I still like this as a short. If I had to pick one, I'd stick with the Russell, which I obviously have a much larger position in the Russell. But I think they're both good for shorts. I think the dollar is going to pull back and go back below 102.50. And that'll be good for my Nikkei short, but not particularly good for these shorts because the dollar's weaker. It can send the indexes higher. So we're just going to have to wait and see what happens, okay? But I just think these guys are overextended. I think all these guys are overextended. But also I will say there's a big caveat here because tomorrow We're so close to 20,000, you can just expect all kinds of shenanigans to get us there. All right, so we'll see what happens, and we'll pick this up again next week. All right, thanks for coming, everybody.